What's up everyone? William here, and today, we're diving deep into 5 penny stocks trading under $1 that could potentially transform your portfolio in 2025. Now, before we jump in, I want to be crystal clear. Penny stocks are high-risk, high-reward investments, and you should never invest more than you can afford to lose. These stocks are volatile, they're speculative, and they require careful research and risk management. But for those of you who understand the risks and are looking for asymmetric opportunities, today's analysis could be exactly what you've been searching for. We're going to cover financials, quarterly performance, partnerships, and everything you need to make an informed decision. So hit that subscribe button, drop a like if you're ready to explore these opportunities, and let's get started. The penny stock market is fascinating because it's where some of the biggest gains and losses happen. We're talking about companies that are either struggling to survive or are on the verge of explosive growth. The key is identifying which category each stock falls into, and that's exactly what we're going to do today. I've researched 5 companies trading under $1, and I'm going to present them in ascending order, from the most speculative to the most promising. By the end of this video, you'll have a complete understanding of each company's potential, their financial health, and whether they deserve a spot in your high-risk portfolio. Let's start with our 5th company, BABB. This company has been positioning itself in the artificial intelligence and defense sector, which sounds incredibly promising given the massive government spending on military AI systems. The key catalyst everyone's watching is their pursuit of US military AI contracts, which could be transformational if secured. However, BABB faces significant execution risk. The company's track record on contract wins has been limited, and they're competing against defense giants with established relationships and proven capabilities. Their quarterly reports have shown minimal revenue from government sources, and the sales cycle for defense contracts is notoriously long and unpredictable. The company's financial position shows they're burning through cash while waiting for these breakthrough contracts to materialize. For investors, the question is whether BABB can actually execute and win meaningful military contracts before their capital runs out. This is a speculative play that requires watching contract announcements closely, and unless you see concrete evidence of government contract wins with disclosed dollar amounts, I'd recommend extreme caution here. Moving to our 4th position, we have GACM Technologies. This company operates in the IT and fintech space, focusing on emerging markets, which presents both opportunity and risk. The key catalyst that's attracting attention is their explosive quarterly profit growth. GACM has been reporting significant percentage increases in profitability, but we need to understand the base we're growing from and whether this growth is sustainable. The financial health of GACM Technologies presents a mixed picture. They've moved toward profitability, which is a major positive for a penny stock, but liquidity and cash flow remain concerns. The company has been expanding their fintech offerings in emerging markets, providing payment solutions and financial technology infrastructure where traditional banking is underdeveloped. GACM has announced partnerships with local financial institutions and technology providers. However, the high-risk rating is justified because emerging market operations come with currency volatility, regulatory uncertainty, and execution challenges. GACM's growth could stall if they encounter regulatory obstacles, if local competition intensifies, or if macroeconomic conditions in their target markets deteriorate. For those willing to take on geographical and regulatory risk in exchange for exposure to high-growth markets, GACM presents an interesting opportunity, but it's definitely not for conservative investors. Now let's talk about our 3rd company, Cognition Therapeutics. This is where we enter the biotech space, and this company gets an extreme risk rating for very specific reasons. Cognition Therapeutics is a clinical-stage biopharmaceutical company focused on developing disease-modifying therapies for Alzheimer's disease, and their key catalyst is the clinical trial results for their lead drug candidate, CT1812. This drug targets the sigma-2 receptor complex, which represents a novel mechanism of action in Alzheimer's treatment. The company's recent quarterly reports had shown advancement through their phase 2 clinical trial program. The safety profile of CT1812 has been acceptable so far, which is the first hurdle any drug must clear. Their financial position is typical for clinical stage biotech. They're pre-revenue, burning cash on research and development, but they've raised capital and have sufficient runway to reach key data readouts. The extreme risk designation is because this is a pure binary bet. If CT181 to show statistically significant cognitive benefits in their clinical trials, the stock could increase tenfold or more because the Alzheimer's market is enormous and treatment options are extremely limited. However, if the trial fails to meet its primary endpoints, the stock will collapse because the company's entire value proposition depends on this single drug candidate. For investors who understand biotech and can afford to lose their entire investment, Cognition Therapeutics represents a legitimate lottery ticket. This is not a stock you buy and forget. You need to follow every data release and be prepared to exit immediately if trial results are negative. Our second company is WM Technology, trading under the ticker MAPS. WM Technology operates in the software sector serving the cannabis industry, and their key catalyst is cannabis legalization and platform adoption. The company owns and operates Weedmaps, which is the dominant technology platform connecting cannabis consumers with licensed dispensaries while providing software solutions to cannabis retailers. This is a real business with actual revenue, real customers, and a proven business model. The medium risk rating reflects regulatory uncertainty around cannabis, not fundamental business execution risk. The company reported approximately $70 million in quarterly revenue with gross margins exceeding 60%, which demonstrates the scalability and profitability potential of their platform business model. WM Technology has been strategically shifting their revenue mix toward higher quality, more predictable business software revenue rather than relying solely on advertising. Their software solutions help dispensaries manage compliance, inventory, point-of-sale systems, and customer relationships. They've secured partnerships with multi-state operators and are positioned as the infrastructure provider for the entire cannabis retail ecosystem. The catalyst for explosive growth is federal cannabis reform in the United States. If cannabis is rescheduled or fully legalized at the federal level, the entire industry will experience massive expansion. WM Technology would be the immediate beneficiary because they already have the dominant market position, the technology infrastructure, and the brand recognition. For investors who believe cannabis legalization is inevitable and want exposure to the best-positioned technology company in the space, WM Technology offers compelling risk-reward at current prices. Now we've arrived at our top pick, Expion 360, trading under ticker XPON in the green tech sector. The key catalyst here is the massive transition from traditional lead-acid batteries to lithium iron phosphate batteries, and Expion 360 is perfectly positioned to capitalize on this secular shift. The company designs, assembles, and distributes lithium battery systems for recreational vehicles, marine applications, and off-grid power solutions. Traditional lead-acid batteries have dominated the RV and marine markets for decades, but they're inferior in almost every way compared to modern lithium technology. Lithium iron phosphate batteries last 5 to 10 times longer, charge 4 times faster, weigh half as much, and provide more usable energy. Expion 360's recent quarterly reports have shown consistent revenue growth in double-digit percentages year-over-year. While the company is not yet profitable due to scaling investments in manufacturing and research and development, their gross margins have been improving as they achieve production efficiencies. The partnerships and distribution agreements Expion 360 has secured are impressive. They've established relationships with major RV dealerships, marine distributors, and specialty retailers across North America. What really differentiates Expion 360 is the convergence of multiple powerful secular trends. The RV and marine industries are experiencing sustained growth. The electrification trend is expanding beyond cars, off-grid living is moving from niche to mainstream, and technology improvements are making lithium batteries increasingly affordable. From a valuation perspective, Expion 360's market capitalization is remarkably small relative to their revenue trajectory and the size of the addressable market they are pursuing. For investors looking for a company with fundamental business strength, proven product-market fit, and exposure to multiple growth drivers, Expion 360 is the standout opportunity on our list today. Now, before we wrap up, I want to provide you with a visual summary of everything we've covered. Let me show you an infographic that captures all the core points of today's analysis. Looking at this comprehensive infographic with our summary table at the top, you can see the complete picture of these 5 opportunities arranged from highest potential to highest speculation. The comparison table immediately shows you the critical differences. Xpine 360 in green tech with the lithium battery transition catalyst facing manufacturing cost challenges. WN Technology is software riding cannabis legalization with regulatory risk. Cognition Therapeutics, a biotech with extreme trial risk but massive Alzheimer's market potential. GACM Technologies in fintech showing profit growth in volatile emerging markets. And Bobbin AI Defense waiting to prove execution on military contracts. The detailed sections below break down each company's financial health, partnerships, and trajectory. You can see Xpine 360 leading with the strongest fundamentals, real revenue growth, and multiple secular tailwinds. WN Technology follows with established $70 million quarterly revenue and dominant market position. Cognition Therapeutics shows the classic biotech profile of high cash burn funding critical phase to trials. GACM displays emerging market exposure with improving profitability metrics. And BABB sits at the bottom with compelling positioning but limited proof of contract success. My recommendation is crystal clear and based on risk-adjusted return potential. If you're going to allocate capital to penny stocks, position sizing is absolutely critical. These should represent small positions in a diversified portfolio where total loss won't impact your financial goals. For most investors, I strongly recommend focusing exclusively on the top 2 companies, Xpine 360 and WN Technology, because they have real businesses, actual revenue, improving unit economics, and clear paths to profitability. These aren't pure speculation. They're undervalued growth companies that happen to trade at penny stock prices. Cognition Therapeutics is worth considering only if you thoroughly understand biotech risk, can monitor clinical trial developments closely, and can psychologically handle the binary nature of drug development where you either make several times your money or lose everything. The bottom 2 companies, GACM and BABB, should only be touched by extremely aggressive speculators with very small position sizes who can afford complete loss and have the time to monitor developments constantly. Remember, penny stocks are not traditional investments. They're speculative positions that require active management, strict stop losses, and disciplined risk management. Never invest based solely on any single video or source. Do your own comprehensive due diligence, read the quarterly reports yourself, understand the competitive landscape, and always have a clear exit strategy before you enter any position. Risk management will determine your long-term success far more than picking the right stock. Thanks for watching. I'll see you in the next one, where we'll dive deeper into the markets. Make sure to subscribe so you don't miss out on more research-backed insights.